everyone. This is Ceylan Cembilek from the German Marshall Fund's Ankara office, and I have the honor of opening today's discussion and welcome you all on behalf of GMF. Today's discussion is only for 1 hour, and the topic, the global economic impact of Russia's war on Ukraine, is a very timely and important one. So I don't want to take up too much of your time. I just want to mention one peculiarity about this meeting, that it is a part of the Trilateral strategy group meetings that we have been organizing in partnership with TÜSİAD, Koç Holding, and the Ministry for Foreign Affairs of Sweden since 2009. Unlike the previous private events, this one is a public one to reach out to a wider audience. So for that, I need to start with thanking you all for joining and making this more significant. And then I want to thank to our speakers for taking the time, and to our partners, of course, to TÜSİAD, Koç Holding, and the Ministry for Foreign Affairs of Sweden for the long-term partnership. Today, we have 4 speakers. Isabella Törngren, Deputy Head of the EU Department at the Foreign Ministry of Sweden, will provide us some brief opening remarks. Then we will hear the analysis of our 3 speakers. GMF Senior Fellow, Jacob Kirkegaard. Welcome, Jacob, by the way. TÜSİAD's Chief Economist, Gizem Öztok, Altınsaç, and Center for New American Securities, Adjunct Senior Fellow, Rachel Ziemba. GMF's Vice President, Ian Lesser, will join us to moderate the discussion. And the second part of our discussion will be reserved for your questions, which you can submit via the Q&A box, and then we will do our best to respond all of them. So without further ado, I leave the floor to you, Isabella. And please turn on your camera and microphone. Yes.
Okay, I'm with you. So good afternoon to all of you. And I'm pleased to be here today and would first like to thank the GMF, Öztok and Ceylan, for organizing today's event. The Ministry for Foreign Affairs is a long-standing partner of GMF and their Trilateral strategy group. And if I'm not mistaken, this year we celebrate 10 years of partnership. I also want to extend my thanks to all the speakers for your participation. The 24th of February is a date that we will all remember. The Russian unprovoked and unjustified aggression against Ukraine has led to the most serious security situation since the Second World War, and is creating great uncertainty not only in Europe but globally. Since the Russian invasion, we have seen intensive international and European cooperation. The reaction to the Russian aggression has been quick and resolute. Sweden and the EU have undertaken extensive efforts in response to Russia's invasion of Ukraine. Sweden's government has decided on both military and humanitarian support to Ukraine. Sweden was already one of the largest aid donors to Ukraine prior to the war. The EU has also substantially increased its support. In close coordination with other partners, the EU has agreed on unprecedented packages of sanctions against Russia and Belarus. And today, more than 40 countries apply sanctions like these. This will have significant impact on the Russian economy. However, the economic consequences of the Russian invasion go far beyond Russia, with increasing energy and fuel prices, higher inflation, and expected lower economic growth. The world economy is also suffering from a global shortage of grain and rising food prices caused by the Russian aggression. The UN World Food Programme warns that this will impact the most vulnerable and poorest countries. There must be no doubt that the responsibility for this severe situation lies solely with Russia. In these difficult times, there is an obvious need for discussions about the global economic impact of Russia's war on Ukraine. And the Trilateral Strategy Group meetings, with a unique blend of perspectives, offer an excellent forum for this. And I look very much forward to the discussion. Thank you.
Thank you to you, Isabella. And then now I will give the floor to Jacob if he is available. Jacob?
I am very much available.
Okay,
pleasure
perfect.
to be with you.
The floor is yours, Dan.
Well, thank you very much. And it's a pleasure to be with you for the second time in a not too long ago since I was last there. But today I want to really focus on, I think, the broader geopolitical, if you like, implications of the unprecedented economic sanctions that we have seen levied against Russia since the 24th of February. Because I think we have really set in motion some very significant developments that will have far-reaching implications well beyond certainly Europe, but also, of course, the immediate conflict countries of Ukraine and Russia. Because if we start with the first category of sanctions, those that concern export controls based on technology, this is not, of course, a new type of sanctions. The United States and Europe and others have used them before. But certainly, this is the first time where technology sanctions have been applied by such a wide-ranging number of countries outside of a UN Security Council resolution. Because basically participating in these sanctions are all of the G7 countries, plus a number of other OECD countries, as well as very important high-tech production centers in Asia, including Taiwan and Singapore. So what it basically means is that, broadly speaking, technology sanctions today are levied against Russia by every country in the world that has or sells and manufactures advanced technology, semiconductors, etc. So these are simply goods Russia cannot source today outside of China. So the question, of course, is, has China been supplying Russia with these kind of dual use or high technology goods? And I think we can now say pretty unambiguously that the answer is no. Certainly, China has been politically unwilling to condemn the Russian aggression, invasion, war in Ukraine, but Chinese corporations have clearly so far voted with their feet and have not actually increased their presence or, for that matter, exports to Russia, and certainly not in sanctioned categories. In fact, if you look at it, it's very interesting, in my opinion. You can see that the most globally oriented Chinese companies, even those with very direct government links, including Huawei, which is, of course, a company that has been sanctioned by the United States before, but also UnionPay, they have actually been reducing their exposure and product availability in the Russian market. So the commercial logic, the same kind of logic that actually saw a lot of European companies leave the Iranian market when they're threatened by US unilateral sanctions some years ago, simply because it didn't make any sense commercially to stay in Iran and lose access to the US. The same logic now applies to Russia for Chinese firms. If you're a Chinese firm with global aspirations, and there are, of course, many of those, it makes no commercial sense to stay or even expand in Russia if you run the risk of losing access to all the advanced economies in the world, which is exactly what these companies are facing. So the bottom line is that we are now in a situation where Russia is and will almost certainly continue to be denied access to virtually all high-tech goods from advanced production centers around the world, including, I might add, China. This is something that certainly already has, and I think will continue to directly impact. It won't end but it will certainly impact the war on the ground, because Russia will not have access to the kind of precision-guided ammunitions, etc., that they otherwise would have. So from that perspective, I would conclude that the technological sanctions are, in fact, so far an overwhelming success. If you then go to the financial sanctions, they were initially implemented, again, in an unprecedented manner. We saw the freezing of a large part of Russia's foreign exchange reserves, by Russia's own account, upwards of about $300 billion. And here, I think, a little bit like in the technology area, the key point is that we're not talking about just the dollar here. We're not talking about the United States only. We're talking about all the countries that control the world's free-flowing, freely traded reserve currencies. Japan, the UK, Canada, Switzerland, obviously the euro, Canadian dollar, you can go down the list. What that means is that, the significant move out of dollar that Russia had initiated for its foreign exchange reserve after 2014 really didn't help Russia very much. This is a signal, I think, and obviously I think a signal that has very far-reaching implications also for other countries around the world, not least China, which is, of course, a country that has, not ruled out invading one of its neighboring countries in Taiwan. But when you are in a situation where all the, if you like, real reserve currencies of the world may actually impose sanctions on you, depending on your foreign policy point of actions, well, then there are clearly a new level of geopolitical risk associated with having very large foreign exchange reserves, which of course is the case in China, which already has about $3 trillion worth of foreign exchange reserves. And I would go as far as to say that this is a development that actually calls into question the long-term wisdom of having for countries that run large current account surpluses, accumulate very large foreign net financial assets in the form of foreign exchange reserves, they are subject to some powerful international sanctions on those financial assets. Because if they, like we saw in Russia, for instance, invade a peaceful neighbor, going forward, I think the norm will be that they will have these assets frozen. Doesn't mean that they cannot retaliate. I mean, if you're China, for instance, obviously you can nationalize a lot of the inward foreign direct investment in China. So you could have a very damaging economic tit-for-tat war there. But nonetheless, I think, what we have seen with these sanctions, financial sanctions against Russia, which, by the way, haven't clearly not worked against the ruble, because when the ruble is no longer convertible, the exchange rate is probably not that relevant actually. But I think the bottom line is that pre-saving or self-insuring, accumulating large amounts of foreign net assets, foreign exchange reserves by aggressive governments is a lot more dangerous or risky than it used to be. And this is certainly something that will continue to be the case going forward. So also on the financial sanctions, therefore, I would contend that they haven't caused a collapse of the ruble yet, but that's because we have designed them in such a way that energy trade can continue. But they have certainly changed the broader risk picture facing aggressive regimes like the Russian government in Ukraine, but also elsewhere going forward, which is also what I would consider a success. So let me lastly say that there is a downside to this, because what we have seen is, or what we're likely to see, is that this new coalition, you can call it G7 plus, of overwhelmingly advanced economically advanced democracies that have sanctioned Russia very powerfully, This coalition is likely to lead to the end of the G20. I think we need to conclude there won't be a leaders summit this year in Indonesia. And we've already seen it during the IMF World Bank meetings that G7 representatives, OECD, EU, and other representatives walk out when Russian government representatives speak. So it is not without costs for global governance that this economic sanctions coalition against Russia is now, if you like, more operational and in fact quite effective vis-a-vis Russia. There are real costs. Certainly the G20, as I said, I think we need to conclude that it will fail or stop functioning, at least as long as Vladimir Putin is president of Russia. But we also have to question whether other global organizations like the WTO, the IMF, and others can actually function as long as there is this clear schism between the technologically advanced economies and many of the others around the world. So let me finish there. I think that was more than my allotted time, so I apologize. Thank you.
No worries. Thank you very much, Jacob, for walking us through the what worked and what didn't, and also on technological level, but also on financial level as well. We are now curious to hear about the US perspective. So Rachel, over to you.
Thank you very much. Thanks to all of you for having me to the GMF and others. And the great thing about following Jacob here is that I can say that I agree with a lot of what he said and move on to some other areas. I think I'd like to start in a sense where he left off, which is highlighting some of this sort of strains in the global economy, and particularly the absence of emerging market economies in this broader coalition. Obviously, there are many that are effectively complying with the sanctions and the like, especially the technological sanctions. But I do think in a sense, just as we were thinking 2 years ago or so about what global trends were maybe exacerbated or sped up by the pandemic, there's a question mark about what fractures in the global economy might be, exacerbated by this invasion, as a whole range of bilateral and multilateral institutions are framed sort of through this lens of this risk. I also want to spend a little bit of time talking about what we've seen so far from the Russian economy. Jacob highlighted that the ruble sanctions, have maybe not worked to the same extent. I want to talk a little bit about why that is and what policy choices the Russians are making that other sanctioned countries have made in the past, and what that means going forward, particularly now that we're sort of on the cusp of potentially greater actions on that all-important energy transactions, particularly in Europe. Before I kind of get into that, I think it's worth reiterating 4 ways in which this sort of sanctions package are unique. Jacob mentioned several of them, but number 1 is the scale of the country being targeted, particularly in the commodity markets. While Russia may not be a large share in the global economy, its share in a wide range of commodity markets, oil, gas, food, fertilizer, we're all very well aware of, plus also with the conflict, Ukrainian production is off, and sanctions that are in place on Belarusian exports, particularly of fertilizer, have also implemented it. And I mentioned this partly because it's one of the question marks we have to ask when we're thinking about limitations of sanctions. Number 2, the breadth of the countries that came together. Having started by saying that there are concerns because emerging market allies and adversaries are not in this coalition, I think the breadth of this coalition that's come together, the speed, is really unique. And that is a function of the conflict on the ground, but it's also a function of greater efforts to build and reach out to particularly transatlantic partners and within the sort of G7 and some of the wargaming, in a sense, economic wargaming that took place before the invasion. These measures, of course, have not been identical across all countries, but it is unique. It is unique and speedy. The cohesion, I would say, does reduce some risks that people worry about and write a lot on the op-ed pages, especially around dollar dominance. I do think having almost all the convertible currencies, banning these transactions has a significant impact. Also, I would say these sanctions are now focusing on closing loopholes so that even not so convertible currencies and not so convertible digital assets, maybe we'll come to that in the Q&A about cryptocurrencies and the like, are also sort of not areas that can be sort of funds can be hidden. Number 3 is this use of new tools of coercive power. Jake was right to highlight that export controls aren't exactly new, but this is the first time that measures like the foreign direct product rule have been used on broad countries' industrial base. Before that, the largest target that it had been used on was Huawei itself. So no wonder it is cautious of running afoul of US extraterritorial measures that limit the export of anything that touches US intellectual property. These new tools and the sort of broad coordination across different government departments in the US and its allies, I think are really a reflection of the way in which the Biden administration has been thinking about closing any loopholes in coercive statecraft. And we see that, some of that has been building over several administrations. Number 4 has been the response of the private sector, which, especially in the early days, really went above and beyond in announcing suspensions and exits. Also, that I think reflected in part the speed at which sanctions were coming into effect. It reflected the situation on the ground, and it also reflected some of the economic choices that Russia was making, especially around capital controls, that they could sort of look ahead and raise questions about this operating environment. Now, of course, we can talk a little bit more. Some of the countries that have suspended activities may not actually have left. There are questions about how that will work. But I do think many companies in the US and Europe and even Japan no longer see Russia as a reliable partner in the same way. And I'll come to that in a moment. So what's been the impact? We've highlighted the pressure on global commodity markets. We've highlighted the mixed impact on Russia's economy. The initial economic or financial shock was extensive. The ruble fell, it became untradeable. There was a lot of capital outflows, stress on Russian assets. That has subsided in part because the central bank adopted defensive, almost textbook policies that might be used in a financial crisis. But those have come with a cost, I would argue. All of the measures we've talked about, both the capital controls and the export controls, have resulted in a decline in imports and the like. Some of these medium-term measures will probably build over time, resulting in a Russia that is smaller and more insular and arguably more state-led in a way. The US and its allies have tried to target sanctions on the government, on state-owned entities, on oligarchs, but as those go wider and wider, by nature, you can't target to the same extent. There was a goal of not targeting the Russian population, as we have seen articulated in the sanctions review from last year. But when there is a desire to really raise the stakes and costs for the government, it's hard to end up targeting in that way. And that is something where also the economic policy choices of the Russian government become quite important. But because they can have a choice of how that pain is distributed. What's ahead, though, I think, is a Russia that is more insular. It's lacking in global financial markets. They may not need it to the same extent as some other countries. They have been willing to forego growth for many years. They might not have wanted to forego as much growth and contraction as they are experiencing now. But this is a country that it's perhaps easier to identify economic strains and pain than it is to lead to an obvious, to necessarily trigger that policy change. The Russian government is not going to make it easy for foreigners to exit. They haven't held true to their threat to nationalize assets yet. They may not have to. But as Jacob highlighted, at this point, it remains to be seen whether Chinese and other entities will be interested in increasing their stakes in a country which is subject to a lot of restrictions. Where China is concerned, of course, there is an important balancing act focused on the sort of long-term impacts of this sort of show of force, but also concern about direct sanctions and focused on the sort of areas of building up their own resilience. And that, I think, leads to more focus on de-Americanizing supply chains for the future rather than medium term, rather than short term measures. So far, other entities like countries like India, yes, have been willing to buy a bit more discounted crude oil, but are not necessarily in a space of investing a lot. The Gulf countries, too, have put investment on hold, and I think are very much waiting on the sidelines, waiting to see. It's notable to me from a sort of a US and G7 perspective that, in a sense, this sort of invasion has brought to the fore both inconsistencies on sort of climate and energy security dynamics, including the speed at which we move towards the energy transition, but also other concerns about reshoring and not fully coherent trade strategy. But that may be something we can come to, in the Q&A. I want to conclude. I know I'm running up against my time. With sort of, what's next, particularly on the sanctions side. I alluded at the start that the direction of travel clearly towards more sanctions. European entities are thinking very seriously about whether they can move beyond phasing out coal to phasing out oil. Gas is a different dynamic. There still seem to me to be debates about whether that should come in the form of a tax that limits the revenues that Russia receives, or whether there should be a full ban. I think it'd be very difficult for the global economy to go cold turkey and the like. I think the impacts and distortionary effects suggest going for a phased-in approach. The other big issue is how far to crowd in emerging market buyers, especially China and India, as I've alluded, but in that way, that crowding in would be via secondary sanctions, which raise their own set of issues. I'm happy to say about some of the more technical issues of how that could work and the different trade-offs. But overall, this is sort of the direction of travel, in part because energy revenues remaining relatively robust, despite self-sanctioning, coming at the same time as imports have started to collapse, have actually meant that the Russian government revenues have been increasing. And while I don't think that's a failure of the sanctions regime per se, I think it does highlight how long a process this might be, and this sort of element of trying, there are not easy choices ahead for new measures. And as the sort of the US and as allies look for new areas of asymmetric power, I think the direction of travel will really be on making sure that Russia is less able to benefit from these reductions and restrictions. The problem here is that now that there's been this coordination of the G10, the G7 plus, now in dealing with the next sort of phases, it's going to be very important to coordinate with some of those emerging market countries that are on the sidelines, whether it's in providing alternate energy supplies, whether it is in just even assessing the food shortages. And so that's going to be the important diplomatic challenge, and making sure that some of the other priorities around the pandemic, around economic activity, debt sustainability, you name it, don't fall completely off the radar. With that, I'm going to stop and look forward to your questions and the rest of the discussion.
Thank you very much, Rachel, especially adding on what is realistic or not, and also mentioning what is next. Before leaving the floor to Gizem Hanım, I just want to remind that you can submit your questions via the Q&A function, and then we will just respond them. Gizem Hanım, floor is yours.
Okay, thank you for having me, first of all. And maybe it's better to draw a top-down approach regarding the Turkish economy, because it is not just war, but it is the tighter financial conditions as well. And then we can get into detail regarding the war impacts over the Turkish economy. Well, as we enter the second quarter of this year, we are at the precipice of a new period in which the global economic and political outlook has completely changed. And after the COVID crisis of the past 2.5 years, the global economy is facing a new supply shock, the Ukraine-Russia war and its ramifications. This turn of events has the potential to trigger both short-term and long-term changes. The preliminary effect that we will witness will be the sustained global inflation. Same holds for the Turkish economy as well. The possible supply shortages in commodities, energy, and various food products will continue to put upwards pressure over the prices. That being said, economies will try to adapt to the global supply chain shift. The war in Ukraine has added an important element of uncertainty to the early changing conjuncture, with global supply chain bottlenecks, sudden increases in energy prices, and inflationary pressure. In addition, Russia and Ukraine are the two most important global grain suppliers. In general, there is likely to be a continuing problem in the global supply chain, especially on the agricultural commodities, which inevitably indicates the global food inflation will not be a temporary phenomenon. And same holds for the Turkish economy. Our imports from Russia regarding the grain imports are playing for about 30% in total imports. And we also import energy on that side. So in these two products, not from the energy side, but on the grain side, now Turkey is searching for some other suppliers like the India or the United States. And this new period may lead to a quicker and more pronounced polarization of global economies. On the one pole, the United States and European economies will come together, and likewise economies such as China, India, Russia, and Iran may align with each other. They may even form their own payment systems and implement their own trade agreements in the future. At this conjuncture, the change in the growth dynamics will also gain importance. For example, the United States economy is expected to grow by 3.5% and 4% in 2022, according to Bloomberg estimates. And it is now obvious that Fed will continue to increase interest rates one after the other while shrinking the balance sheet and monetary tightening aggressively. These all put pressure over the Turkish economy, not just the war, but also the global financial tightening impose risks over our economy. The expansionary monetary policy that we have witnessed in the last 14 years from the United States side has completely changed now, and this change will have different effects on all economies going forward. Less accommodative monetary policy in advanced economies will pose challenges for central banks and governments in emerging markets like Turkey. For Europe, the growth trajectory may be different from that of the United States. Therefore, the European Central Bank may not have a big comfort of saying let's tighten the monetary policy, but loosen the fiscal one, like the Fed is planning to do. I know there appears a wide range of opposite views regarding the direction of the monetary policy in Europe, but recall that the Vice President Guindos just told yesterday that European Central Bank should be able to phase out asset purchases in July and pave the way for an interest rate hike. The war in Ukraine actually poses a huge risk in Europe due to its proximity to the war zone, a refugee inflow of 6 million, almost 5 to 6 million people in the first stage, and its commercial ties to the region. Any mistake in monetary policy coming from Europe has the potential to drag Europe into recession. And inflation is high and growth is under pressure. And think about the case, the war broke out while Europe was just reaching its pre-pandemic production levels. Therefore, rather than inflationary demand, there appears more supply-side inflation in Europe. And in this regard, European economy is now estimated to grow almost the half of the last year, let's say 2.8%, over last year's 5.4% GDP growth. In this regard, we're watching the magnitude of the pressure on European growth very closely, which could possibly hurt regions like Turkey, where 50% of our exports are linked to Europe. In 2021, Turkey exported goods and services that totaled almost $95 billion to Europe. And this year, we were initially working with an annual export increase of 20%. However, it is possible that Turkey's exports will slow down significantly after the latest developments. European demand is the most important factor for our exports to Europe, while the effect of the depreciation of the lira is very limited in terms of offering a competitive advantage. Therefore, a possible slowdown or a stagnation in the Eurozone will also negatively affect Turkey's export revenues and contribution of net foreign demand to growth. This is the most likely risk that we are witnessing right now. The Russia-Ukraine war might affect the Turkish economy through 5 channels. Those are for sure inflation, foreign trade with Europe, commodity prices, which means a wider external financing need, and finance channel with the rising country risk premium, and the tourism channels. We are now working with a number of 3% GDP growth for this year, which was almost the same once we begin this year. So we are not revising it down yet, but we are watching the export developments, tourism developments, and some financial links. And there are downside risks for sure. The growth this year is stemming from the household consumption in Turkey, while investments in net foreign demand, because of Europe, are likely to put pressure over our growth. Currently, we do not detect just the delivery times are getting longer with the trade with Russia, because we are buying mostly energy and grain, but there is a little bit problem about the supplies of grain and maybe some other products. And the ministry and the companies are working on searching for new suppliers as well on that side. And delving into the economic effects for Turkey, at first stage, we estimate a cost of approximately $30 to $40 billion. Think about a case, Turkish economy is $800 billion. So in our short-term figures, we're working with a possible cost of $10 billion from exports, stemming mainly from the European exports, and $5 to $6 billion from tourism revenues, and minimum additional energy cost of $15 billion. So these are resulting in a wider external financing requirement. Of course, these are the short-term back of the envelope calculations. We're following the recent developments on the tourism side, which now seems better than we have initially thought. We see actually foreigners from Russia at home as well that we have to mention. And previously, we were expecting 6 million tourist arrivals from Russia. The share of Russia and Ukraine in terms of tourist arrivals in Turkey's total arrivals is something around 15%. So we were expecting 6 million tourist arrivals from Russia, but after the war, we had to revise it down to 3 to 4 million arrivals now. The most important part is the transportation and number of flights between Russia and Turkey. So it depends mostly on the number of flights, if we can have the Russian tourists or not. But you know that Turkey is in huge need of FX inflows. So in terms of investments, there appears some capital inflows via businesses or the relocation of some Russian companies that we hear as well into Turkey. But it is not easy to give any sector name right now. Of course, these are the short-term capital inflow developments. For the longer term, there appears 2 major opportunities for the Turkish economy. of course, it is not so so nice to talk about any economic opportunities when there is a big humanitarian disaster. But beyond this damage, there appears two openings. The first is the rebuilding global supply chains, and where Turkey can reshape herself and relocate herself in the new supply chains. And the second is the energy corridor in Eastern Mediterranean. Actually, we need more and more time to talk about recent developments regarding these fronts. And finally, I can give you some details regarding the Turkish economy going forward in the coming 1.5 year time. We continue to have the stagnant story, a higher inflation and an increasing need of external financing. So this war and also the global tight policies on the global arena puts pressure over our inflation and also over our external financing needs. Mainly the energy costs puts a high pressure over inflation and the FX need of the economy. And, you know, Turkish economy's growth is based on capital-led growth. So we need the foreign flows. And actually, we are working with a number of Turkey is likely to reach 70% inflation in the second quarter or maybe the third quarter of this year. And for the long view, as for monetary policy, there is a process of time inconsistency in our country, like premature interest rate cuts from time to time and delayed rate hikes in some periods. So the inadequate economic policy framework adopted as of September 2021 is deepening the inflation currency interest spiral that is troubling our economy. So it is not just war or the global financial conditions, but some inadequate policy mix at home. And as global front is facing war-like supply shock and price increases, as I just told, we're working with a 70% inflation right now. And for the year end, our number is 50%. And the need for the foreign financing of the economy, the total need of the foreign currency in this year is almost $200 billion, 25% of the GDP. And when once we account for Turkey's own vulnerabilities, access to the needed foreign currency becomes expensive, both in terms and quantity and price in the global arena. So there appears a question of funding of growth for the rest of the year as well. And actually, we need to adopt a comprehensive economic policy design in that sense to cope with all of these external vulnerabilities. And it may be somewhat difficult for the economic growth this year to be supported significantly by the investments and export channels in 2022 with the above mentioned developments, actually, the developments that I have just mentioned previously. Thank you for now. So if you have further questions, we can get into details.
Thank you very much, Gizem Hanım, especially depicting the specific case Turkey is witnessing. And at this point, I will just hand it over to GMF's Vice President, Ian Lesser, to moderate.
Okay, well, Ceylan, thank you very, very much. And thanks to all of you, just on behalf of GMF from my role anyway, to say thank you to all for joining and thanks to our speakers. And I'll say some further thanks at the end, but we have some time for questions. There's some that have come in the Q&A. We'll invite you to think of some more. While you're doing that, I'm just going to throw out a very quick one, and maybe one of you or two can pick it up. If just listening to all of you, it just struck me that, there is this sort of massive revival, renaissance, I don't know what to say, of strategic risk as a factor in global economy, but also in terms of private sector planning for insurance purposes, for many, many other things. You could have a whole conference on this, obviously, but just in a couple of words, maybe just to come to all of you while others are thinking of questions. How is this going to affect business planning going forward? I mean, from say the trilateral perspectives, very briefly. Jacob, maybe I could start with you just to go in the order.
Yeah, sure. No, I mean, I think we have to look at, I certainly view the war in Ukraine as a deglobalization accelerator, unfortunately. Because what it does is that it has crystallized some of the, certainly on the geopolitical sense, cleavages between this sort of authoritarian versus the democratic camp, if you can use that expression, or that sort of bifurcation of the global economy. And the sanctions obviously highlight the risks placed on companies that continue to try to span the divide between the two, because you can very quickly get into situations, unforeseen situation, where you're forced to choose. And that, of course, as a number of companies are finding out in Russia, can be very expensive. And their shareholders are going to demand that they take appropriate, remedial or preventive measures. So this will just accelerate a trend we have already seen coming, I think.
Okay. Jacob, thank you. Rachel, how does it look to you?
Yeah, I would tend to agree. I think, in a sense, for a lot of companies who were already facing increased compliance and due diligence costs, in the context of thinking about, especially in the United States, China exposure relating to, are there links to forced labor in Xinjiang? Are there exposures to sanctions? I mean, I think one of the things that has become different here is we're dealing with a wider set of sectors. We are also dealing where there are countries like the United Kingdom, for example, after many years and many decades of sort of not paying too much attention to where the money was coming in from, have made some some changes that I think will that may play out in ways we haven't addressed. In the United States right now, there continues to be a sort of conference process around the America Competes Act that includes investment screening of money going out from the United States. I'm not sure that will pass in the final version, but I think in many ways some of the things that are going on now, greater scrutiny on trade, on investment and the like, might end up with more regional zones. And we'll address in that way. So it might not mean less global trade, but it might mean, particularly in sensitive technologies, greater sort of obstacles and the like. And that's where I'm also sort of really watching any new kind of any new developments in that way, or any new entities that might emerge to take on from, say, the Wassenaar process that monitors export controls. But that may be a topic for another discussion.
Absolutely, we're accumulating them, but thank you for that. Gizem, from your perspective and what you see, how it's affecting Turkish business and others, I mean, strategic risks, business planning.
Well, actually, we had to divide the businesses like the banks, real sector, and exporters and tourism. Actually, for the banks, the US sanctions are binding. OFAC is binding over there, and they are very, very strict on that issue. So they continue to apply the United States sanctions on that side, mainly the private banks. And they're doing, actually, they don't have very big problems right now. At the beginning of the crisis, they had some troubles, but now they do cope with all of them. And for the real sector, actually, the United Nations sanctions are binding for Turkey. So for the real sector, we don't see a big trouble over there, just stemming from the sanctions. But the problem is the delivery times and supplier of some products like timber, lumber, coal, grain, all of them actually. But we know that the trade is continuing between the two countries, but with a huge longer delivery times actually. And on the investment side, we continue to hear the relocation of some, software companies, law companies into Turkey. But we haven't seen this money inflow yet in the figures. We're just hearing, and also there appeared a huge demand for the real sector as well, by the way. regarding the businesses. And for the tourisms, actually, we will be watching the May numbers. We see the risk over there, and we're not very positive right now, but we hear some positive news from the big tour companies that it won't be that bad as we had first envisaged. So these are the short-term plans. And for the longer-term ones, we'll continue to develop our defense industry, and we will continue to do some further steps regarding the energy corridor in the Mediterranean. So these are the long-term strategic business issues. And we need to relocate. We need to get further place in the global supply chain, if we can, of course, for the longer term.
Thank you. We have a couple of questions that have come in, but please, we've got a few minutes. If you have some, please, this is your moment. But let me try to group a couple of these together also. A number of them, and some of them from the same person actually, but the good questions about the durability of sanctions. How the expectations about how long we're going to be living in this world of sanctions on Russia as a kind of strategic adversary. I'm happy.
What do you think?
What are you betting?
No, I think obviously it's going to be heavily influenced by events on the ground. But if you take the view that this could very well become a fairly lengthy war of attrition, and with it, we have seen obviously war crimes, being committed at various locations in Ukraine. Given that, and I think as more and more stuff comes out from Mariupol, we're likely to see a civilian death toll, even under circumstances that replicate but certainly exceeds that of Srebrenica. This is not a war and a conduct of war that means you can just go back to the status quo ante, even if the guns stop shooting. Which is another way of saying that I think these sanctions are de facto in place until Vladimir Putin is out of office, which again is, of course, another way of saying that they're going to be with us for a very, very long time, potentially.
Thank you, Jacob. And this leads us to a question, which is, particularly interesting in this trilateral discussion, that obviously, we have three very different kind of, in some senses, structural approaches to sanctions in this case here across the Atlantic, but also Turkey, which has its own very distinctive approach to sanctions. What about secondary sanctions? To what extent in Turkey, for example, are you concerned, and there will be European countries concerned about this too, that the United States is going to go for, start doing extraterritorial secondary sanctions that Turkey obviously is not going to be comfortable with? What's the thinking around that, Gizem?
Well, actually, if you are asking the secondary sanctions, that maybe I have to clarify it to implement sanctions to the other countries that continue their ties with the Russian economy, or the further sanctions regarding the Russian economy.
Well, the sort of thing that that we've seen in the past with regard to Iraq and Iran, where the United States has sanctioned foreign entities that continue to do business with countries under sanctions by the United States, basically, with or without.
Well, actually, yes, I understand. Actually, as far as I just told before, the United Nations sanctions are binding, and Turkey is, mainly the banks are completely restricting themselves with OFAC. So in terms of these sanctions, we don't currently see any problem. And the Turkey's role is very important in this war, actually. So actually, we don't expect any harm coming from that side currently. But getting back to your first question, it is a new era, and I definitely agree that there won't be any backstep from the sanctions any near time.
Okay. A couple of other things have come in. We have very little time, but so I'm going to just sort of throw these out and see who would like to take them up. Some of them may have natural answers. There's a question from Paul Levin about Swedish unions actually working on docks, who have actually complained that some of the, there are too many loopholes, in fact, in sanctions that are affecting maritime trade. I mean, can we see this? We've seen this phenomenon in other places where, in fact, some publics are demanding tighter sanctions than actually exist. Can we expect more of that? Rachel, I see you nodding.
Yeah, I mean, I think it's this gets to the point I think we've all alluded to of sort of private sector and sort of stakeholder pressure to do more, and the difficulty of disentangling these efforts. I think we have a dynamic right now from sort of sanction implementing entities in the countries that are, you know, in a sense, facing this challenge that there are a number of exemptions, including on the humanitarian side, that can be difficult to implement. We know from other countries that it can be very difficult to maintain basic humanitarian trade because of the cost-benefit analysis for businesses. But I think here where shipping and insurance and the like is so impaired, I think that's an issue. You know, I wanted to say something super briefly about the secondary sanctions piece. One thing that I think is a bit unique in approach, this sort of time around versus some other sanctions entity, is that I think the Biden administration in particular sort of set out and said that they weren't going to get ahead of the Europeans. They weren't going to get ahead of some of their allies, and that maybe the measures wouldn't look exactly the same. But that doesn't necessarily extend to other countries outside the G7, outside the G10. And I do think where the energy piece sort of comes in, as and if that escalates, those questions are going to become more and more important. We've already seen mixed messaging towards India, for example. And I think that's one reason why I think there will be elements of existing sanctions that the secondary measures are enforced. And Jacob and I think both highlighted that the technology ones already are not exactly secondary, but they're at least at impacting and restraining other countries. And then I think we might see it especially on efforts to close financial loopholes. So for example, any dodgy crypto exchanges or mining operations or the like, we might see them targeted in that way. I think we're still far from sort of a point of full sort of secondary sanctions. Finally, this is also where Congress could come in, right? And that's something for right now, even though there's some legislation, there's not necessarily been mandated secondary sanctions in any way. It's interesting, often when I talk about sanctions, Congress comes up a lot. They have not necessarily been in the driving seat in this context, and I think that's probably for the best. There are other tools that Congress can use to help in this area. But as things go forward, and if the situation on the ground continues to deteriorate, I might be worried about sort of that piece, even though there's a lot of sort of consensus in Congress that the multilateral relationships are very important.
Rachel, thanks. And I am conscious of our time. Gizem, if you don't mind, maybe I'll just finish with you if I could. Just a question has come in about, there are a couple of them actually that relate to energy, but in particular, just very, very briefly, can Turkey make a fundamental change in its energy dependency on Russia? Is that something that you would expect?
Yes, she can make, and also she can has the opportunity to use the Mediterranean corridor as well going forward. So everyone, actually, we do try to do the diversification, not because of war, but before the war as well.
Gizem, thank you very, very much. Thanks to all of you, Rachel, Gizem, Jacob. Thanks so much for being with us. Thanks again, and I'm sorry I joined a little bit late. Isabella, thank you so much for your opening remarks. Let me just say a big thank you, as always, to our partners in this long time trilateral exercise. It's been taken different turns in the virtual world, but it's been great. To TÜSİAD, to Koch Holding, to the Swedish Ministry for Foreign Affairs, we're really very, very grateful. A special thank you to you, Ceylan, for this, for making it all happen, and also moderating in my absence, and also to Öztok, as always, in Ankara. Thanks to all of you who've joined us. I wish you a very, very good weekend. And we look forward to seeing you at GMF again soon. Thanks so much.
Thank you.
All the best.
Thank you so much.